People always ask me, Cédric, I clearly researched the tech, read the white papers, and picked projects backed by top firms like A16Z and Paradigm. So why in the hell, after holding for almost 2 years, did my position drop to 90%? Cédric, tell me. When I hear those stories, it really bothers me inside, you know? I smile a lot, but it's really bothering. But honestly, it's not because you lack vision at all, in fact. It's because from the exact moment you clicked on the buy button, you stepped straight into an exit trap that someone else had already designed with rules built just for you. At the beginning of 2026, this global anti-VC movement exploded. Everyone finally woke up and realized those god-tier projects valued in the billions weren't real financial innovations. They were actually exit tools, especially manufactured by institutions to harvest the Bitcoin and Ethereum held by regular retail investors like us. So today we are skipping all the fluffy technical jargon, and I'm gonna break it down for you step by step. How this shadow power structure called the crypto cartel or the cabal or stuff like that turned a beautiful decentralized dream into straight up institutionalized plunder. Let's start with some data that will send chills down your spine. Between 2024 and 2025, the vast majority of listed projects, they used an extremely sneaky tokenomics model. High FDV, low circulation. So you thought that you were buying a potential winner, but you actually bought the last grain of sand right before the floodgates opened. At launch, these tokens usually had only 5 to 13% of the total supply in circulation, and the remaining 90%, it was all locked up tight in the hands of VCs, teams, and foundations. That artificial scarcity, combined with non-stop media hype, it easily pumped prices sky high early on and triggered your FOMO. You felt like you'd miss the next 100x coin if you didn't buy right now. But here is what actually happens next. According to the FDV calculation formula, when those locked tokens start unlocking for the VCs, the tiny liquidity in the secondary market can't handle the massive sell pressure at all. And even if the price crashes 90%, those VCs who entered at rock bottom prices still walk away with tens or even hundreds of times their profits. You are the one left standing at the peak, becoming their liquidity as they exit. This logic, from a pure math standpoint, already handed retail investors a death sentence. So you might be asking, but Cédric, don't the exchanges do anything? Don't the regulators step in and do something? That's a great question. And that's exactly the core we are exposing today. The crypto cartel. This isn't a legitimate company. It's a shadow alliance, powered by shared interests. In this closed loop, everyone has their own role to play. First, you have the top-tier VCs like A16Z. There are the token factories. They monopolize chips at ultra-low prices in the seed round, and then they orchestrate tech miracle narratives through their media networks. ZK, Layer 2, AI agents, you name it, blowing valuations through the roof. And then there are the mainstream exchanges, the centralized exchanges. They act as the retail storefronts. They control the scarce listing slots, and they have quiet agreements with VCs to push these VC coins to users at the highs. There is even evidence that exchange insiders use early info to build their own position or team up with market makers to lure retail longs at the top. And then there are the market makers. They are the hype crew. They use complex algorithms and fake wash trading to manufacture the illusion of hot volume and rock-solid prices. They bait you into entering and taking the bag. And then the regulators, the ever-changing regulators, the officials, they are the most hidden piece. And you have to know, VCs hire former government bigwigs as executives to leverage connections and write rules that only benefit the inner circle. Those so-called innovation exemptions, they are really just slapping a compliant label on illegal fundraising. When you get scammed, you can't even find legal protection. This is what we call government business integration. So together, the four together, they build a crypto bourgeoisie. It's a new kind of class that's even more opaque and unconstrained than traditional finance. And if high FDV is the slow poison, then the winter nuke event in 2025 was the knockout punch. A major exchange was accused of suddenly slashing leverage limits on multiple tokens with zero warning. That move was brutally sneaky and instantly flooded the market with hundreds of millions in liquidation orders. With no real buyers on the other side, prices dropped like a kite with a cut string. Meanwhile, market makers tied to the exchange calmly scooped up cheap chips at the bottom. They completed their violent trade on every leveraged player. We talked about that, I did a video about that. This proved a brutal truth. Exchanges have never been neutral matching platforms. They are predators. Yes, there are predators who can rewrite the rules anytime and jump in themselves to take their share of the meat. So by now, you might be thinking, this market is just simply unplayable that way, right? In a way, but let me tell you the narrative reversal happening in 2026. There is something happening right now, and it's a great thing. Retail investors are waking up fast thanks to this kind of videos, and the data that they can see clearly now. People are rejecting those high valuation, low circulation projects and turning instead to true fair launch models. No more VC pre-allocation, no private rounds, 100% circulation from day one. Everyone competes on the exact same starting line. In this era full of manipulation, Bitcoin's value has actually been strengthened like never before. Why? Because it has no CEO, no centralized foundation, and not a single penny reserved for any venture firm. That extreme purity makes it the only sovereign asset capable of fighting back against cartel plunder. Yeah, I got a few final words for you guys. Some rules of thumb if you want. Don't fall ever again for the so-called elite narrative. If a project is born with a valuation in the hundreds of millions, it's probably not there to make you money. It's there for you to foot the bill. Then learn to use on-chain tools right now. Investigative creators like CoffeeZilla, they are checking token distribution with things like bubble maps. You should too, you can access those tools too. Stop listening only to media hype and look at who actually holds the chips on-chain. Third piece of advice, go back to Bitcoin's core. The more chaotic things get, the tighter you hold those truly decentralized, fairly distributed native protocols. What we need to do isn't run away from this market, the crypto market in general. What we need to do is to master spotting exit liquidity traps and return to crypto's original vision as a global sovereign asset. That's what you need to do. See you in the next one.